Do you believe in the big news interest rate relief is on its way for homeowners across the nation? Today we're going to look at the forecast that the Australian inflation rate will continue to decrease, meaning there will be home loan interest rate drops coming. In this video I'm going to look at what these forecasts actually are, should we give these forecasts any weight, and what it means for borrowers if the rates do drop. Before we jump into the topic of what the experts are forecasting, we need to set some context on how interest rates and inflation are related. The core issue here is that if interest rates are dropped too quick, it can increase inflation. This is because when money is borrowed, a large portion of the borrowed money is actually created. It's not sitting in some imaginary electronic vault somewhere. So if interest rates are dropped too low too fast, it creates more borrowing, which creates more money in the economy, which forces price of things up because people will pay more for scarce things like property. To avoid this, the RBA has set a target Australian inflation rate at 2 to 3%, and they adjust interest rates based on this.
As you'll have seen, the board decided to hold its policy rate steady again at this meeting. First of all, we're making progress in our fight against inflation, but it does remain high. As we've discussed before, in fact at this previous press conference, it really is the big challenge in front of us. It confronts borrowers, renters, savers, retirees. It hurts everyone, inflation. And that's why it's so important that we get inflation back into target band of 2 to 3%.
Now we've set a bit of context, it's time to talk about what the forecasts actually are. ANZ forecasts that the cash rate reached its peak at 4.35%, which is where it currently stands, anticipating reductions to commence around November 2024, aiming for a decrease to approximately 3.6% by mid-2025. CommBank also sees 4.35% as the peak, with expectations for the initial reduction around September and a projection of rates falling to about 2.85 by mid-2025. NAB's analysis agrees on the peak rate of 4.35% as well, with predictions for the first cuts to be in the December quarter of this year, and a target rate of 3.1% by the close of 2025. Westpac aligns with the peak rate as well of 4.35, forecasting the initial decrease around September, with the cash rate expected to stabilise at 3.1% in the September quarter of 2025. Now we've established what the big banks have to say about this issue, let's have a look at some of the RBA data to see if they match up. If you look at this table, which was finalised on January 31st this year, you look at the GDP growth, and the December 2023 quarter was actually very similar to the previous year, 1.5% versus 1.6% GDP growth. The remainders are all actually forecasts. The unemployment rate is the same and is forecasted to increase to 4.3% by the end of the year. To put this in some perspective, it's still considered full employment when unemployment rates are between 4 and 5%. What's interesting is that despite the mass immigration of the last couple of years, the unemployment rate is almost the same. What's interesting about the inflation rate is that it's still forecasted to be over the RBA's target rate of 2 to 3%, which is 3.2% by the end of this year, and then dropping below at the end of 2025 at 2.8%. So the big four banks are potentially looking at this and assuming the RBA will start easing interest rates if the Australian inflation rate continues to drop as it has been doing for the last 15 months.
I don't think the RBA would undertake further rate hikes without a serious and considered need for it, but I think that's the weakness in the market view, where all the discussion is around the timing of rate cuts, whether or not there is the chance of further rate hikes.
The question is, why would the Reserve Bank of Australia reduce rates when, if they do nothing, they will hit the inflation rate target, And if they cut, they risk increasing inflation. Should we give these forecasts any weight? Let me answer that with a statement. The only thing that's certain is uncertainty. For example, oil prices could go up because of the risk of war. Energy prices are forecasted to continue going up. Rent and property prices have been going up, and it's looking like they'll continue to go up. Let's put all of that aside and assume the best of these forecasts, which is CBA expecting an Australian inflation rate of 2.85% by the end of 2025. That's equal to about a 1.5% decrease in your home loan interest rate. So if you've got a $500,000 home loan, that's about $145 a week you'll save. This is a meaningful amount, but beware, this would put your home loan interest rates below the long-term average. How do you play this? Times are not as easy as what they were before, there's no doubt about it. However, I don't think making assumptions on what will or won't happen is helpful due to the uncertainty of the times we live in. I think you have to play the hand you've got and not hope for a better hand in 18 months' time. That's not an easy situation to come to grips with. I guess I'm very conservative when looking at these scenarios. I am biased here because I have an opinion which I put out on a video late last year with my thoughts on the future of the Australian property market and the Australian inflation rate, which you can watch via the end screen. I'm in the process of creating a community aimed at helping people answer the question of how do I make it financially, because yesterday's solutions don't necessarily work anymore. I hope to share what others are doing and document their experiences with the hope that it helps community members. The link will be in the description. If you're still hanging around, please give us a subscribe. Cheers.